Hi folks, Larry Berman here, and here's what's on my radar this week. Well, very positive week overall, even though it didn't end on a terribly positive note. A lot to think about in the coming weeks, but this week in front of us here is big tech earnings. It's Fed meeting, and so earnings season so far, Companies beating earnings, less than typical, but companies beating earnings, still good. So what does that mean? It means earnings expectations are still in line, and the forward guidance has really yet to take any meaningful hit lower. So, it looks like 2022, we're still going to see earnings growth at this point. The real bearish scenario for stocks are if earnings take a really big hit down because we actually are going into a pretty severe recession. There's no doubt from a technical perspective, we're already in a recession. We've talked about that in recent weeks. GDP now, Q1, it's clear. And as we've talked about, it's all inventories. We have yet to see consumption take a dip down. ISM numbers, terrible. Weekly claims numbers starting to tick up. But when you think about the structural side of the economy, 160 million jobs in the US. How many jobs have you had in your lifetime? How many times have you been laid off? Just do some rough math in your own head there. And say, well, I've collected unemployment insurance 3 times in my life, once in my life, maybe never if you're lucky. But most people at some point, sure. So if you run the numbers, what you end up seeing approximately in any given month is about 1 million people get laid off as a matter of just normal day-to-day business. And so that's about 250,000 a week in initial claims. It's kind of where we're sitting right now. So right now, there's no meaningful uptick in terms of we're going into an economic slowdown and they're starting to lay off at a faster rate than what's completely normal economic behavior. And that's may very well be where we're going, and we're paying very close attention to. Why? Because ultimately that has everything to do with consumption, and that is 70% of the economy. So where are we heading? Jury's still out. The market's discounted an awful lot if the recession we're getting so far is all we're really going to see. And I don't think anybody can tell you with any clarity whatsoever, how bad or not it's going to get. But it'll be very interesting what the Fed does this week. I think 75 is where we're at. I think they're going to leave the door open and very open for another 50 and maybe another 50. They will tell us likely at the Jackson Hole after seeing another series of data, are they going to pause? And some very smart people that I talk to on a regular basis think the worst thing the Fed could do is pause. I think the market's getting excited at the pause. It's all about inflation and inflation expectations. And from that lens, things are still very well balanced. So let's take a look quickly at some of the market-based indicators and charts this week. What I'm looking at here is the S&P 500. And if you're just looking at today's price action, about an hour ago, it looked really bad. 2 o'clock, just after 2, end of day was looking bad. I saw a lot of chatter on the Twitter sphere and in chat rooms about a bearish engulfing pattern, and that's bearish and blah, blah, blah. And now we have dark cloud cover and it's bearish connotations. But you might also look at it and say, we broke above the 50-day average. We're consolidating. It's completely normal. And really, the Fed day, what it does on that day, and where the real resistance is to this move is not here. It's actually in this range where we got to, because remember, the May low, inflation peak, boom, no, inflation didn't peak. oh, inflation didn't peak. We didn't make a lower low. So I think we got to go up and revalidate this level. Look at where this trend projects into Jackson Hole. So I think we can grind a little bit higher here. I don't think today's price action means a whole lot. So a quick look at the long bond TLT, long bond ETF. Bumped up against resistance today. I took some money off the table. We have been talking about buying pretty aggressively, as yields in the 10-year got to 3.25, 3.5. So the best of that trade for now is probably behind us, where the US 30-year went sub 3%, and the US 10-year finished the day at 275. There's probably not a whole lot more upside here. Top end of a downtrend channel. You can see price, if we blow this up a little bit, kind of rejected that test, even though we had a big gap overnight in the ETF and moves in interest rates. So, stock stronger, bonds sell off, buy the dip in bonds for now, but by no stretch of the imagination are we out of the way. Are bonds a good investment? Tactical trading vehicle, absolutely. So now when we think about our bull and bear pick of the week, where are we going here? So bear pick of the week is going to be to fade the rally in bonds at this point. And, where do you put your money if you think interest rates are going to back up a little bit? Insurance companies, banks, kind of, look interesting here. Again, for a trade. Everything here is for a trade. It's way too early for anybody to pound their fist on anything. We'll learn more in the next month or so, but Jackson Hole, I think, is going to be a big event for the Fed and for the markets. And they'll give us, they ought to give us some better guidance at that point. So until we get to Jackson Hole, everything's a trade here. It's very tactical. With that in mind, have a great week, everyone.